and welcome to our next session. If you've stayed since the morning, which I'd be very impressed if you have, you'll have seen that we've gone from a macro perspective on the funding journey from seed stage to exiting. In the last session, we talked about the value of death and bridging the funding gap, and now we're going all the way back to early stage funding with a brilliant panel who actually also worked very closely with. So Beverley Gower-Jones was a judge for Tech Nation on our climate program, as is Pippa Gawley from Zero Carbon Capital. So you're in very good company, and it's brilliant to have a few familiar names with us. And this session is all on financing early stage climate tech companies. And Beverley, I'll hand it over to you. And Beverley is a partner at the Clean Growth Fund. So Beverley, over to you.
Thanks very much, Sam. Well, welcome to this session on identifying funding early stage growth investors, innovators even. I'm going to kick off by asking the panel to introduce themselves, and I'm going to start from the bottom end. So Pippa, would you like to just do a brief introduction?
Hi Bev, thank you. Hi everyone. I'm Pippa Gawley. I'm managing partner at Zero Carbon Capital. We're an early stage VC investing at pre-seed and seed stage in scientific innovations addressing the big unsolved problems of climate change.
Hi everyone, I'm Hugh Barlett. I'm the Senior Investment Exec at Green Angel Ventures. I'm not up on the board, but I'm over there. My colleague Cam isn't able to make today. We invest anywhere between seed and Series A. We're thematic on green, so hardware and software and everything in between. Our typical ticket size is around 650k.
Hi everyone, my name's Shaikh. I am the head of the greenhouse at Imperial College, and we are a climate innovation startup accelerator. So we take really early stage climate innovation and accelerate them up so these guys can invest in them.
Hello, hi everyone. Angela McKane. I was working at BP for some 15 years, and I left last summer to get right in amongst it with startups. So now working for Colbridge Ventures, working with early stage startups across the UK. Nice to meet you.
Hi, I'm Andrew Wordsworth. I'm the co-founder and CEO of Sustainable Ventures. Sustainable Ventures currently operates a pre-seed fund, but investments represent less than 10% of the 600 plus companies we've supported to date in a variety of ways, and we're headquartered in Europe's largest cluster of clean tech companies based in County Hall in London.
Thank you, and I'm Beverley Gower-Jones. I'm the managing partner of the Clean Growth Fund. CGF is a 101 million VC fund. We invest in seed and Series A and have currently made 18 investments to date, particularly in companies in the UK that have the potential to significantly reduce greenhouse gas emissions. I'd like to start the session, and by the way, if you want to ask the panel questions, if you put them in the Slack channel, then I'm supposed to be able to read them on here and ask the panel. So do feel free to send your questions through to me. So to kick off, then, Hugh, I'd like to start with yourself. What would you say the most important thing to successfully finding early stage deal flow? And how do you find deal flow at Green Angel Ventures?
Yeah, absolutely. Thank you. We're remarkably lucky in that a lot of our leads are generated organically, and so companies apply via our website. But I think one of the key things is actually, as a startup, the ecosystem that you're already a part of. Speak to your co-founders. The best funds will have a high reputation and will be held highly amongst your peers. So for a startup, I'd recommend that. But also that works the other way around. Actually, if you as an investor are able to find good companies, speak with them as well. Who are they speaking to? Who do they recommend? Who sits in the same accelerator offices as Sustainable Ventures? And those sorts of things is one of my absolute go-tos. And then obviously the kind of things like the Innovation Zero event is a really good one to connect and it's a slightly depressing world that we're so well connected to each other and we know each other so well, but in many ways we should use that to our advantage and actually speak with one another as co-founders, as co-funders, as we're all aligned in the same mission. So that's where I would primarily go.
Thank you, Hugh. And Andrew, what would you say to that, doing the early stage investing? What's the most important thing to finding early stage deal flow, and how do you find it?
I'd probably build on what Hugh said. I think partnerships is a clear differentiator for all of us. It's like, even in terms of companies that go to some of the later stage funds, if they're too early, they'll move us to us, and vice versa. So there's a lot of sort of interchange between there. But also for us, partnerships with universities, and it's great to see you here as well. So we've been working in partnership with Imperial College on the GLA's Better Futures programme for about 7 or 8 years now. And those sort of partnerships you form with universities, it's not just going and standing and having a logo on your website. It's actually working with them, and that allows us to find companies at the very early stage, particularly in kind of deep tech.
Thank you, Andrew. Pippa, coming to you, what do you look for in a great founder? Specifically, what skills and experience should they have?
Yeah, so we like to invest in pairs of founders. So we look for companies with at least 2 founders. We think that the idea should be good enough that they've managed to convince at least one other person to join them, whoever the kind of original idea generator is. So we look for, first and foremost, for the scientific skills, technical skills that they're going to need to develop their idea, and the commercial skills to build a business. So that might be in the same person, it might be split between the two somehow, but we need both of those things to be there. Then we look for the founders to be ambitious. We want to have a big impact, and we're only going to do that with big companies. So we want people who are ready for that journey, and they want to build a big company with us, supporting them. And finally, values aligned. So we have to know that they're kind of motivated by the same thing that we are in terms of decarbonising the world. Because then, when the pivots happen, as they surely will, at least we're all going to be happy with where they end up.
Thanks, Pippa. And Jim, actually, a question from the floor, which happens to coincide with the question I was considering, which is great. So I'll read the one from Owen Jackson. How important is having tangible technology IP ownership versus team experience expertise in a technique idea for investors? So how important is IP in the mix when considering early stage clean tech investing?
From our point of view, fortunately or unfortunately, IP is a really key aspect of a deep tech or climate innovation. A lot of climate innovation tends to be hard tech rather than software, and to get investors to invest really early stage hard tech, you do need IP, and you do need to have that IP not necessarily secured, but on its way to being secured. You do need to have a new idea, something new that's innovative and that's quite unique. Now, it doesn't need to be a patent, it can be know-how, but you do need to understand how to frame that, and that's from 2 sides. One, from the point of view of defensibility, so as you go forward, how do you defend your proposition? And secondly, freedom to operate. So how do you know that you're not infringing somebody else's IP as you go forward?
Andrew, I know you've done quite a lot with your companies on crowdfunding platforms. Would you say IP has the same importance when looking at that kind of form of funding?
I think it's probably less on crowdfunding platforms. I think, but as I say, we probably have moved away from that a little bit. But I, if I look at the balance of our portfolio. We used to do sort of about 50-50 between sort of software, which is sort of business model innovation, versus sort of hardware and deep tech. We're now shifting away from that. We've all invested in well, some of us haven't, but most of us have invested into clothes swapping websites at some point. It became quite fashionable with Debop. But I think and those sorts of things do appeal to consumers and sort of retail investors. But I think that we're seeing trends moving away from that, and we're definitely moving, with the tone of the more serious investors, which are saying actually we recognise if we're going to tackle climate change, we have to invest into deep tech, because those are the solutions that are really going to solve problems.
And Angela, do early stage climate tech companies need support, and what does best in class support look like for you?
Yeah, they do often need support, and I think listening to some of the questions that have come back around already, one thing that I would maybe disagree slightly with Pippa on is we're okay with solo founders, but I think they need a certain type of support. Like it's okay to be really passionate about your idea, and often those sort of iconoclastic dissenters are the real disruptors of the world, so that can be really good in a founder, but they need to be coachable as well. And I think organisations like Colbridge and others can come in as partners, real thought partners to founders. So even if they don't have a co-founder or a co-partner on that very original founding team, they can be open to advice, challenge, constructive dialogue, which can lead to even better innovation, I think, on both sides. Building that trustful partnership between you is so important to make that work. Founders often have to be, especially when pitching, uber confident and really at the top of their game, but once you build that relationship, it's important to be able to be vulnerable, to just talk about where you're having the problems that we can help you unstick. And the other thing I would say on that as well about the deal flow question, finding those founders, we've heard a lot about referrals, warm introductions, the power of our networks. We are in a really exciting age now. There's a real equalizer with the fact that social networks have connected us in ways never before. I'm being connected to some people on the panel I'm meeting for the first time in person today, but we've already been in discussion. And I think there are exciting ways to use that for finding new deal flow as well. Let's not forget we're in the age of AI, so we can deploy these algorithms to help us find the next big investment. If you think of things like we talked about IP, use something really clever to scan those patent searching databases. You might uncover the key innovation that could be something that's a big game changer in the future, and others might not be looking. And then you can sweep in and partner with those founders as well.
And Jim, you do a lot of support to companies in the accelerator. What types of support do you think is most useful, and how do you do that? How do you deliver that to your innovators?
We've sort of focused down onto 3 levels or 3 platforms of support now. So because we take really early stage founders who are still, they may be technically conversant, but they haven't run businesses before, and there's a lack of knowledge. So one strand of what we do is a talk element of webinars, masterclasses on core knowledge. I mean, very basic things such as R&D tax credits, how to apply for them, all the way up to marcoms, plans, sales masterclasses. That's one element. The second element I think is really, really important is coaching and mentoring. So we have a large program around business coaching, personal coaching, sort of taking founders from founders to leaders, and then we bring in some people in the audience as mentors to actually help our founders as they get into the commercial discussion. And then last but not least, we provide equity-free funding. So that's one of the things that we do. Because we're philanthropically funded, we can provide 20k or so to founders to start them off and as they go forward, and to enable them to work on their project for a period of time and then get the necessary funding to go forward.
Thank you. Before Clean Growth Fund, I founded Carbon Limiting Technologies back in 2005, which specialised in helping low carbon entrepreneurs commercialise technology through a number of different incubators and accelerators. And I think my thoughts on best-in-class support, it's really around one-on-one, hands-on support. One-to-many workshops and conferences and so on can get you so far to understand the theory, but the difficulty is in putting the theory into practice. And so to really have an experienced mentor who's got over 20 years experience, who can really sit with the team and actually help design the business model, help figure out the value proposition, which is often quite difficult, makes an absolute massive difference. And so I think those are some of the ways that that support can really add colossal value. And in terms of value inflection points, finding partnerships with corporates is key, because you can do those first demonstrators and start to build those corporate relationships to really cement that product market fit. And I think that's absolutely critical. And CLT still does a huge amount of that to this day. So we've had lots of questions come in on the chat, which is excellent. So I have a question here in terms of Pippa, we'll come to you. What's the best-in-class approach to get a deep tech company investment ready? In particular, if the funders can't afford being unpaid for long times.
It's a great question. I think there's often a kind of tacit assumption that founders are going to be full-time somehow with no money. So getting ready for investment, I mean, there's a lot of people who will invest very early stage, including us. We've invested in corporation rounds before, and several of the investors here do invest at pre-seed, very early pre-seed. There are also angel groups who might be able to go even earlier than some funds are comfortable doing. So I think always start off by trying to get some money so you can get yourself ready without having to do everything on a total shoestring. You might be eligible for some grants or other kinds of support, perhaps from an academic institution if you have associations there. There are also venture builders who, like Carbon 13 in Cambridge, who are able to give you the kind of support that you need and financially to help you get ready and even find another founder to partner with you if you need that and help you develop your idea. So there are other organisations like that across the continent as well. If you're interested in more of a deep tech approach, like Marble in Paris, they have a real focus on deep tech type companies. So and finally, do talk to investors early on, so you can start putting together the data, the information that they need to see. And you can start those conversations ready to go, and keep the momentum up as soon as you do start having the investment decisions.
Andrew, what do you think the best-in-class approach is to get deep tech companies investor ready? What do you do at Sustainable Ventures?
So I think one of the most important things is working with companies to form a staged approach. So finding the kind of niche markets that can basically build their sort of demonstrator technology, get it down the cost curve, do the proof of concept, and then move to the next stage. So an example of that might be Biophilica, who do a sort of leads to leather process. They've focused on the fashion industry, so their first product was a watch strap. Now, sustainable watch straps are not going to save the planet, but they clearly they basically got through the whole process. They expanded their production process to produce the kind of quality that you need in the fashion industry. But they're obviously they'll use that, and the real challenge is obviously the automotive industry, and that's where the real sort of prizes come. So being able to do that in a graduated way allows you to sort of steadily de-risk the thing and build confidence in the larger ticket investors who can then come in and scale the whole business. So that's our main approach we do.
The questions are coming in thick and fast now. I can't keep up, but I'm going to do my best. So Angela, one for you. Business and personal coaching for founders. Does the funder or incubator offer this, or are there specialists that provide the service? So what do you do?
So I think it really depends on what you need when it comes to business and personal coaching. I think if you're working with an organisation like Colbridge, there's a degree of coaching built into the offering because we partner with founders that we feel strong chemistry with, that we really buy into the vision with, and so we will become constructive coaches with you. And I think building that kind of psychological trust between us is something that actually pays a lot of dividends. But there can be moments in the founder's journey where it gets really, really tough. And depending on your own unique circumstances, there are many different coaches and different varieties of offerings out there, and some of which may be more appropriate for your circumstance. But again, we're well connected across those, and we'd be able to recommend some of those as well. I do think that part of that coaching, or even just being there, is for when it gets really tough, and you can reach out and say, you can be a bit vulnerable and say, look, I'm worried that this is, it's taking up a lot of my time, I'm feeling a bit stressed, and we can have a conversation about it. Often those things can be unpicked. It's not necessarily formal coaching, it's more just human connection and conversation. One example would be, I've spoken to a number of founders who came back from the World Economic Forum in the climate tech space, and a couple of them said to me, a bit dejected actually, they said, I felt like last year we were top of the game, top of the track. But this year it feels like it's switched to defence because of where the world is now, and we feel a little bit less relevant. But in discussion with them, we talked about the solution they have, and we also talked about climate change. Can it be catastrophic for certain groups? Yes. Can it be catastrophic for certain groups and populations more than others? Yes. Is that likely to lead to migration and population moves that are going to be hard for the world to deal with? Yes. Is the world already struggling with that? Yes. So do you think maybe this is a defence issue as well? Oh yeah. And so suddenly what had felt like we feel less relevant became, oh, actually we're even more relevant. It's just teasing out that conversation. So I don't know if I would call that formal coaching. It's a form of coaching, but those sort of interactions I think are hugely valuable.
And Jim, I have a question here. What's the value of accelerators offering small investment tickets in clean tech when most solutions are CapEx intensive?
Very good question. The whole point of the accelerator is to accelerate you to the next stage. Now, the next stage for where we are isn't your first of a kind £50 million plant, but it sets you up on a journey, on a stage journey, as Andrew said. So you have to start from somewhere, and the accelerator is a really good space in which you can explore your idea in a safe space that gives you a little bit of money to start off. But you do need to have a stage program. And so within most accelerators, you will get the one-to-one coaching, you'll get the personal coaching, you'll get the mentoring to develop your proposition so then it's investable, such that you can then go on to interest these guys in investing in your proposition. So you have to start from somewhere, but you need a staged approach. You're not going to get to first of a kind straight away.
Question for you, Andrew. Given climate's the biggest economic opportunity our planet's ever faced, are universities doing enough to generate early-stage climate tech spin-out companies?
Interesting. How much is enough? I guess my observation is, in terms of they will be driven by their students and their PhDs. I would say that now climate tech is probably the sector of choice, particularly for young people. So we're now seeing people who 3-4 years ago wouldn't even consider doing a PhD in a kind of a new material, a new biomaterial. We're now seeing a steady stream of those coming out of the various universities. And I'd like to think that universities, that their businesses, obviously Imperial is an absolute business, will recognise that their customers are demanding support for those, and hopefully that will flow through the system. So I think that's. So I'm quite optimistic that even if they're not quite there now, they will be in the next 2-3 years.
Pippa, there's a good one here. How do we make sure that our optimism for climate and that challenge with investor returns, how do we balance those two things when looking at investment opportunities?
So, I think that we're coming from a world where trying to do the right thing, trying to have a positive impact, was associated with concessionary returns. And of course, there are some kinds of impact where that's unavoidable. We think climate is one of the areas where, absolutely these things are correlated. So we believe in profit because of purpose, not in spite of purpose. As you pointed out, this is one of the other questions pointed out. This is one of the biggest economic opportunities we've ever seen. Right? We're having to reinvent the way we do pretty much everything. So we think if you're solving a big problem, then it's going to be very valuable. So that's why we're using the mechanism of venture capital to try and get money to these great companies who are developing the innovations that the world needs, because we know that there will be great returns associated with the impact that they are able to have. So we think that when we're looking at companies, we look very carefully at the techno-economic analysis of what they're doing to make sure that there isn't going to be a green premium that won't be supported by the market. We think if we can get a product that is the same price or cheaper, better, tastier, faster than the one that's in the world today, then that will make the switch to net zero happen as fast as it possibly can. So we see that there's so much in the world today that is incredibly inefficient. Like more than half of the energy that we get from fossil fuels is just wasted as heat. right? So there's huge opportunities there to make the world more efficient and realise a cost saving as well.
And so, Hugh, building on that then, is VC a good match for climate tech? The timescales are long, the capex requirements are large. Maybe it's not a good fit for a typical fund. What do you think?
I would say it's a perfect fit for a fund, as evidenced by the recent statistics on the continued money going into clean tech. I don't know if anyone's seen the kind of latest reports from 2023, but venture capital was very much down, yet clean tech venture capital was broadly flat. So I think the statistics would disagree, but I think generally we'd disagree. If you want a long-term view, the companies that will be around in 20 years will be those that are solving climate change, and the ones which are aging and dormant are probably the ones which aren't doing that. And so, yeah, absolutely, it's very much the innovation for the future is as I can see in clean tech.
I think building on that question, Andrew, the landscape for EPC, engineer, procure and construct in the UK, it's kind of part, right, of a lot of the things we need when we make investments in engineering or hardware. And so, how do we see the landscape to support and scale projects in the UK? What's the EPC status?
Yeah, I think in terms of that's the landscape. What's very interesting now is we're seeing a whole load of new companies, not only developing technologies, companies such as our spin-out AirX, Smart Airbricks, but also people are aggregating and actually finally tackling some of the problems that were identified over a decade ago at the time of the Green Deal. So you've got companies like Schoon, Pippa, who we invest in, and what they're doing is basically bringing together not only the technologies, but recognising and bringing the finance, and basically bringing all those partnerships together. And that's an area that we're starting to explore in terms of where we're working with larger corporates to basically bring so we have Barclays are one of our main investors. So obviously what they do is they lend money to householders and can secure finance for these upgrades against their mortgages. So we're basically working in partnership with Barclays, some of the energy companies, and some of these people like Pippa and Schoon, to really actually now is the point where we can actually get sort of affordable finance and do sort of mass regeneration, a mass refurbishment of properties. So I think it's another example of where individual companies can't bring everything that's needed, but everybody. All those people bring a specialist in finance or our in engineering, and they can together. We can basically bring them all together to achieve like big results.
I think one of the things on that's really interesting is, of course, the large EPC construction projects of the past, such as combined cycle gas turbines, are not required in the future, and a lot of the EPC contractors are looking for carbon capture. Direct air capture, hydrogen and other large kind of construction projects. But maybe one of the things they face in that transition is that there's going to be a lot more distributed energy rather than centralised. And so how do they have the skills, and how do we create the new business model that's going to be needed for that construction world of the future? I see some really huge changes there in terms of the size of projects, and therefore the capital that's going to be required. We might have to amalgamate projects together to make them cost effective in terms of the financing piece, and which requires collaboration and requires a regional approach. So lots of food for thought there, I think. Question here from Hannah Svenhag, hopefully I pronounced that right. To you, Angela. What's key public support to enable to invest more in companies and ideas? So how can the public sector work with venture capital to increase funding?
I think that's an excellent question. I think the key here is partnerships. We heard just there about the different types of industrial partnerships with VCs, and I think the public sector as well. In particular, local authorities, councils in the UK. in some of the companies we've been working with, a lot of it is around things like innovations for electric vehicle charging from home. That's just one example, but it really makes your life a lot easier if you can charge from home rather than having to go somewhere else to charge. And not everyone has a driveway. There's all kinds of startups in the UK doing fantastic things to mean that that's not a problem. But what do you need? You need permitting, you need local authorities to approve the various regulations for these things to happen, and there's countless other examples like that. We want to make sure that those innovations come to market, especially when there is that market pull. So unsticking some of that and having partnerships to make that possible. And it could be that co-funding is part of the story there. If we can have local authority budgets devoted to innovation, we could really unpick some of that as well. Indeed, we are seeing some of that zero emission vehicle mandates and other things unlocking some funding, so that's one way. Another way is, of course, the universities that we heard about. Whether you think of universities as public sector, you could argue that back and forward, but I think key partners, though, for innovation, and especially the exciting developments we're seeing, the number of technology transfer offices and commercialisation activities happening all over the UK. There's really, coming back to the point earlier around how do you source deal flow and find really exciting founders. If you've got a way of crawling across who's working on what across the UK in those universities, you find some really exciting innovation happening really early. And if we can unlock partnerships there, I think we'll achieve fantastic things together.
Thank you. And Jim, question from Marcus. Do you observe a difference in deal flow, execution speed and pre-money valuation within and outside of the Golden Triangle? And there's a few questions that relate to geography, some to do with UK-US geography, but this one is particularly inside and outside of the Cambridge, Oxford, London triangle.
Really good question. We've just done a little bit of deep dive in the accelerator space for the UK. And one of the interesting and quite worrying numbers is 50% of the accelerators in the UK are based in London. So there is a concentration in London, and there's less so regionally. So there is an issue around founders starting up and looking for support outside that golden triangle. And it's something that we're looking to address going forward in what we do and trying to open up what we do. So it's not place-based, it's more hybrid, and we can attract more diverse founders from more diverse geographies. So I do think it's an issue, but I hope there's us and various other people trying to address that. Just a very quick question about the international piece. We're quite fortunate we have a competition entry to what we do, so we get fairly decent startups. And what we found over the last couple of years is about 50% of the startups who have got VC funded have been funded from the US. So there is a large interest by VC funders, from US VC funders in the UK.
And Pippa, there's a question here. Often UK VCs have less attractive term sheets than their US counterparts. Why is this, and does this push UK startups to move to the US?
So there are lots of different reasons for that. I think what the question is asking is referring to is that often the valuations are higher in the US. Often US funds are bigger. They will often have bigger round sizes at higher valuations, and sometimes that can help companies to accelerate their growth faster. So sure, that's all very desirable from a startup's perspective. And yes, there are a lot of US funds that invest in the UK. And there are lots of UK startups who then relocate to the US. It doesn't have to happen that way. So for some companies, it will make a lot of sense for them to consider moving to the US, especially those who can take advantage of some of the tax credits in the Inflation Reduction Act. So in particular, green hydrogen or carbon capture type companies. So that means that they've got a business model baked in to that move, and that can be very helpful. But most US VCs don't require companies to move to the US, and it might be perhaps that it's just a way of unlocking, opening the door to that market, and you could do that through a subsidiary, for example, in the US, whilst keeping your R&D in the UK, if that's the right choice for your company. But the reasons for valuations being higher in the US are very complicated, but I think it ultimately boils down to they have a bigger domestic market. So, excuse me, it's easier for companies to grow there.
Thanks, Pippa. And Hugh, how do you temper a management team to understand that their company isn't $1 billion at this stage, understanding that the value journey is key to their ultimate success?
Yeah, something I feel I'm doing more and more of lately. You have to be gentle, right? You investing in them, you both are aligned in the long-term vision of that company. Having a real expectation of the future potential is where you are both heading. That is not a reality now. That's why you're asking for investment, right? So it's great to have that aspiration. I think when it comes down to it, many of the hard figures would show that you're not at that value yet. And discounted cash flows, although they are great in private equity, you only have to have a 5% error in your financial model, and suddenly your £1 billion company is a lot less. And so we don't use that as a valuation form, particularly at early stage. I think just setting the expectation that, look, this is what our job. Your colleague Beverley said a great line, which was, "We are professional valuers in startups." That is what we do daily. As a startup, that won't be what you do on a day-to-day. And so actually you should leave that element to us, and really set expectation of that, and also that the opportunities out there. Actually, if I am to kind of see two identical companies, ultimately the better value will be the one which we'll go for in the end. And so, tempering expectations and leaving the kind of leaving it to the investor really is what I'd say.
I think there's an interesting dynamic here, because you can run out of runway. So whilst and it's natural that you kind of think, oh great, I've got this fantastic valuation, that's brilliant, and in some senses, yes, that is. But if it's overvalued for some whatever reason, which can happen, it just means the next round is going to be really, really difficult, and likely a down round, which is painful and sends all the wrong messages and signals. So it's like a marathon. You have to pace yourself for the race, right? And you have to look at what's sensible. Can you hit the milestones? And does the valuation make sense at that stage, so that when you come for the next round, you can constantly get a valuation increase, right? So, a short win can often be a failing later on. And so I think it's about understanding that. And if you want to know how long the runway is, you need to go and look at what exits have happened in your sector for your technology company in the last couple of years, because that's ultimately the price that an acquirer is prepared to pay. And therefore that's the length of the track, that's the length of the runway you've got. And so, I think that's well worth kind of bearing in mind. Andrew, how do we approach you to talk about investments? What specific details will make you interested to learn more, and what's an absolute turn-off?
Interesting question. I mean, I think that the first step today is go and see us on our stand, and we'll have a chat to how you do that. So when we look back at our performance of our investment portfolio, we're with Pippa. We generally invest in at least two co-founders. About 80% of our portfolio are still trading, which is, at the pre-seed stage is pretty much unheard of. And the ones that I would say have probably fallen over are ones with sole founders. And I think the point was made about sort of the coaching that the accelerators give. It is quite a lonely existence, and actually having a co-founder you can bounce stuff off is the most vital thing. So that's a definite thing. About 65% of our investments are into female, with at least one female co-founder. So we really appreciate diverse teams, and to quote Susanna, diverse teams. All the evidence points to diverse teams outperform. So we definitely look for that kind of diversity in the founding base. which is, as I say, is an absolute criminal. The wider sort of tech investments, I think it's like 3 or 4% into female teams. I simply don't understand that. I find it very bemusing, but that's great. We're available to snap those bargains up. So yeah, I think it's the usual things, but yeah, it does come down to certainly the pre-seed stage. A lot of it is about the people, and it's a well-owned thing. It's all about the people, but they're the people you're actually backing. And with the right level of support, we can help you find customers. We can help you find further funding, that's the journey you're on.
Pippa, how do people approach Zero Carbon Capital?
Yeah, we're really keen to have an open door. So we have a page on our website that anybody can go to and submit their details. We're all pretty easy to find on LinkedIn. So please reach out, get in touch. And we'd love to have a chat. And if it's not right for us, hopefully we can signpost you to a different investor. As we spoke earlier, we all know each other, and we all have a pretty good feel for the sort of things we like investing in. So, if it's not a fit for our thesis, we might be able to signpost you to a better, more suitable investor for your company. And I think in terms of absolute what you're looking for at that stage, ideally you'd like to see a deck just to give you a bit of a summary about who you are, what you're doing, why, and then there's very little that can kind of rule you out at that point, apart from something that's against the fund's thesis. So, for example, we only invest in companies headquartered in Europe. So, if you're not, then we just it's not going to work. So,
Thank you for that. We've talked quite a lot about finance and how to identify and find early stage companies and some of the considerations, but we haven't really talked very much about the role that corporate venture capital plays in the funding landscape. What more should corporates do to get involved in this? Jim, maybe that's one you want to take.
Again, another interesting question. As I said, I'm coming at it from an accelerator point of view, and what we've seen over the last couple of years is many more corporates looking at setting up their own corporate venturing arms. So very recently we've had IKEA, we've had a large Brazilian manufacturer, we've had Scania. So there's more and more corporates who are now looking at onboarding new technologies into their pipeline. And why we're interested in them is interestingly enough, they are interested in early stage. They'll come in pre-seed and seed, and they're not afraid of scale. So they deal with scale, they deal with supply chains all the time. And so they can understand the technology, and they understand the process by which it can be scaled. And so they're a really new and interesting partner now for startups.
Can you give any kind of specific examples of relationships that have worked well, or
yes.
Maybe kind of what's best practice?
So a couple of teams in particular, we have a few teams now who are looking at low carbon replacements for furniture type materials, wood, polystyrene, packaging, those sorts of things. But that's large scale. They need to understand where they fit in the value chain, where they fit in the manufacturing chain. And what IKEA are able to do for those two teams is one, introduce them to their technical experts inside IKEA who can give them advice and guidance on what they need to do, what they need to consider to be a partner for IKEA, and then introductions to their supply chain, and in which they can really understand how they're going to fit into the manufacturing process. So those two are novel bits of information that teams need that maybe more traditional VCs and PE won't be able to do.
And Angela, what should the innovator take into account, into consideration when building a relationship with a corporate?
So I think there's a number of things to bear in mind. One is, where is a corporate best placed to partner with you? One, they have deep pockets. So for some of the innovations in our sector, let's take a fusion as an example. I'm a fusion hopeful believer, I think, because there's so many startups in the race now, and it would solve so many problems. But there's still very big challenges to be overcome there. It's still going to need people who are going to be able to stick with the journey for future investments until things are cracked properly. So those types of things. Carbon capture would be another example, right? There's really exciting innovations out there. They're still very expensive. So there's a place for corporates where you've got deep pockets is one of the things that they can offer. But I also think their reach, right? So as a founder, be thinking about their global reach, global networks. When it comes to growing and scaling, we heard about how exciting it is to grow in the US, the market opportunity. Global growth is clearly something that you can enable even faster if you've got people who already have that scale to help you. So those are the top of mind things for me. I think would be the first thing to think about. The last thing I would add to that though is they also know where the problems are that need to be fixed. So one of the things that can happen quite easily is we can be developing a really exciting technology, but we might not fully appreciate the actual nature of the problem that needs to be solved. If we take hydrogen as an example, it might be these problems, exciting problems to be solved around, I don't know, keeping it in the pipe, or for some of the areas where we use catalysts like platinum, it's really expensive, maybe we could solve that, and a whole host of other things. Corporates know those problems, they know what needs to be fixed, and they know what they would invest in if someone offered them something that could fix it. That kind of intel, so find the CVCs that have got really good relationships across the business, because they'll know what they're really looking for, what problems need to be fixed.
Andrew, what do you think innovators should be careful of or take into consideration when engaging with a corporate?
Yeah, so we have what we frame something called the entrepreneur's journey. It's just sort of 6 stages of development. What's a common milestone to each of those is funding, people, and customers. And the great thing about corporates is they bring 2 of those things. So they're either customers because they want to buy the product, they're investors, or they're acquirers. So 2 of our last exits were to corporates. So Zygo was bought by Schneider, and Syndicate was bought by Octopus Energy. So clearly there is the potential, and there is growing appetite for corporates that are on that net zero journey to buy these technologies and then help scale them. So we just launched our new corporate innovation arm, led by Simon Brown, who's stood at the back over there. And that's where we can actually provide guidance and basically act as that interface between the innovators and the corporates, and making sure that both of them have different objectives, but nobody's wasting each other's time. So being able to do that, I say we can see that can then help. So a lot of corporates deliver on their net zero ambitions through transformative initiatives, rather than sort of coming down and just being involved in innovators because it's kind of cool. So we actually want to see, we do that because it helps our ecosystem, grow further faster.
Thank you, Andrew. And we're slowly approaching the bewitching hour. But Hugh, we often hear the phrase funding gap for companies expanding into this space. What's that all about, and what can companies do to navigate it?
Yeah, I think it's a really valid question for a startup to be asking. I think there's 1 or 2 which come to mind, where you're too big and too old for an EIS fund, but too small and potentially too young for a larger fund, such as yourselves, Beverley. That's one gap where I think you need to be aware of. So for those companies, be aware of how long it has been since your first revenue and what milestones you need to get to be approached or to be approachable to a larger fund. That would be one tip. I guess for the other funding gaps, I think there are actually there is funding there. It just goes to fewer companies, and a sad reality is that many startups may well die, and there is money available to the ones which are really going on to succeed. So just make sure you're in the top 10%, basically. I know that sounds very simple, but keep in mind that the milestones at the next round that you're going to need. It's always encouraging when a founder sits down 2 days after a funding round closes and says, okay, we've got to keep in mind the next round and who are those next investors going to be? What are they going to be expecting from us? What revenue targets are we going to be expected? If we're a software and we want to do a Series A, we need to hit 1 million ARR. That seems to be the very popular choice. So how do we get to that? How do we make sure our runway is long enough for that? So I would say keep in mind that next round and make sure that you are driven to hit those milestones. And ultimately, the funding round is not the next, it's not the be all and end all. That's not the next target, right? You want to successfully get to an exit, and so funding rounds are just the stepping stone to get to that point. So if you can get to that point beforehand, well, then you don't need any more funding, and so keep that in mind. I guess another thing would be that actually grants and other public funding and private partnerships and those sorts of things, when you do get large enough, can sometimes bridge that gap as well.
Thank you for that, Hugh. I think one of the largest funding gaps I currently see in the space is that Series B plus. So, where you need, particularly with the hardware company, you need 30 or 40 million to build a demonstrator, and yet there's no certainty of revenue coming off the back of that demonstrator, and that's a particularly difficult spot because the VCs at that later stage are absolutely looking for revenue certainty, which is a difficult thing for innovators and SMEs to actually be able to provide. And so I think it's really about trying to de-risk that step, either by looking for niche markets and building smaller units to demonstrate revenue certainty. So we've seen quite a lot of that with some of the carbon capture companies that first went into biogas cleanup before then doing the carbon capture piece. And so thinking about innovative ways around that and looking at how we can use public and private money in a kind of a blended finance way to then, to then be able to build some of those demonstrator projects. But it's really about being really well prepared and well planned and setting that out. Funding rounds are taking longer. 12 months for a funding round now is not uncommon especially through 2023. So really get to it early, and it really is a process, and you have to absolutely manage it like a process. Different venture firms have different mandates, as Pippa said earlier, right, as to what's eligible and what's not. And so it's about quickly figuring out which firms have got the mandate that you fit exactly in the bullseye of. And then building the relationship with those firms, right? Rather than spending lots of time talking to people who actually are never going to invest in you because it's not what their fund does. So I think that's a key part of it. On that note, I think I need to thank the panel for answering all those questions. I tried to go through as many of these as you sent me through in the audience as possible. I didn't get to all of them. I'm sorry about that, but I'm sure we'd be happy to pick up any that are burning issues with you now.